Hey, what's up, everyone? My name is Ali. Welcome back to my world of stocks, and welcome back to my three stocks on sale series for the month of October 2024. Where in each episode, I pick three new stocks that I feel look attractive at today's prices for the long term. And to make things a little more fun and interesting, I specifically choose one lower risk, one medium risk, and one higher risk option for added variety. Now, this month in particular, stocks 2 and 3 are ones that I don't think I've ever covered before on the channel, so you're not going to want to miss this month's episode. It should be a ton of fun. And I can't wait to show you my picks, so let's just go ahead and jump straight into this. Now, starting with stock number one, that's the lowest risk option first. Well, this one, admittedly, I do actually often talk about this one a lot, but I just can't help it. My favorite all-around stock in the entire market continues to be Google, ticker symbol GOOGL, which I know it's climbed a lot already, like most other giant tech stocks, especially among the Magnificent Seven. But something that might surprise you is that Google consistently trades lower than many of its bigger siblings, which I think makes very little sense in my opinion, and should ultimately send Google stock rising even more in the future. Let me explain. First of all, you take a look at their stock price, and despite Google being one of the steadiest and strongest performing stocks out there, well, a recent dip this past month has actually left it down about 16% from the top, which in turn, when you look at the largest companies by market cap, well, it actually leaves Google still sitting at just under a $2 trillion cap, while other giants like Amazon have surpassed that, and even bigger ones like Apple, Microsoft, and Nvidia have all soared north of $3 trillion. Yet, I actually think that Google deserves to be right up there with them. In fact, here's a few charts that I created to help illustrate some of this. Now, you look at their market caps and you can see how Google sits well behind all of them. Yet, when you look at their businesses, Google is performing just as well, if not better than most. When it comes to sales, if you exclude the giant outlier of Amazon, because of course of how many people shop on Amazon.com, well, Google actually comes in just a bit behind Apple with significantly more revenue than both Microsoft and Nvidia. In fact, it's almost as much as both of those combined. And the same goes for their dominance in profitability, where they do almost double the amount of net income as Amazon and are only behind Apple in terms of size at a massive $88 billion last year, basically tied with Microsoft there. But again, those companies are worth more than $1 trillion more than Google. So how does that make any sense? And by the way, it's not like Google is in decline. In fact, they're putting up incredible growth numbers on both the top and bottom line, with sales even rising by a double-digit percent every year, despite them already doing over $300 billion. That's insane. And profits are just as crazy, with EPS growth of over 20% per year expected over the next 5 years. And guys, that's even after they already did over 20% growth in the previous 5 too. So what could it be? Well, maybe you could argue that these other companies are doing a ton of work in artificial intelligence, right? I mean, we've seen lots of market caps balloon recently because of the rise of AI, these past couple years. Well, even there, you could argue that Google is maybe the most important player in artificial intelligence, certainly one of the biggest, because what's at the core of AI? It's data, right? Well, who has more data than Google? They lead almost every internet-based market out there. They have more search, more email, more maps and travel data. They have business apps. They have the #1 market share in digital advertising. That's huge. They have YouTube, the #1 streaming platform in the world. That's even ahead of Netflix. They have autonomous driving with Waymo. They even have the #1 largest smartphone operating system with Android, even ahead of Apple. Plus, they also have Chrome, the #1 browser as well. And they have Gemini 2, the new generative AI platform that's being integrated into many other areas for Google too, including, by the way, their Pixel lineup of products and services, which happens to be similar to Apple's. I mean, they even do AI in healthcare, so they really do it all. Plus, they even have a giant cloud computing platform to help power all of that too, the third largest in the world. So with all of that in mind, what could it possibly be keeping Google out of those, 2 and 3 trillionaires clubs? Well, it's got to be the valuation, right? Nope, not even there. In fact, Google actually has a cheaper PEG ratio than the sector median, despite them being the clear market leader. So I just think when it comes to lower risk stocks, Google is at the top, I would say, for me. I feel that the stock is a buy on any dips, this one included, and even as high as the market cap is already, I actually think that it'll continue to go much higher over the long term. So I love Google stock. All right, moving on to stock number 2. This will be the medium risk option. And for this one, I'm going with a much less talked about name in the travel and online booking markets with Expedia, ticker symbol EXPE. Now, most of you probably know about their bigger rival Booking Holdings that has seen their stock price soar in recent years to a new all-time high, while Expedia, on the other hand, has actually fallen by over 30%, leaving it also at just about the same levels that it traded for as far back as 2015. Now, there's good reason for this, as competition has risen, notably from Airbnb, as well as, again, their bigger brother Booking. And coming off of the pandemic, there's been some ups and downs in the travel market where Expedia has admittedly, not operated as strongly as their rivals. But there's a couple positives, or I would say at least tailwinds, that I like about Expedia in particular. Number one is a recovery in travel following the pandemic. And number two is their dirt cheap valuation, especially compared to those rivals. Now, for some context, Airbnb has been kind of the really market disruptor, right, over the past decade, with lots of growth, doing about 65% more bookings last year compared to before the pandemic. But in the US lodging market, they actually hold just about 17% market share, whereas it's actually Expedia, believe it or not, that together with their various apps like Vrbo and Hotels.com accounts for almost 40% of the entire market. Booking, on the other hand, together with their Priceline and Kayak platforms, holds just a bit over 20%. Of course, internationally, though, is where Booking really starts to dominate, like in Europe, for example, where they're almost completely unmatched. And because of it, Booking does about double the revenue of either Airbnb and Expedia, and the same goes for their profits too. However, everything else is actually a lot closer than you might expect. For one, Expedia does just slightly less revenue and EPS growth at the moment, which, by the way, their EPS growth is actually higher than Airbnb, despite them being, the market disruptor. And yet, when it comes to the valuation, it's Expedia who also completely destroys them with a forward P ratio that is about a third of Airbnb's. It's also close to half that of Booking, and it's 25% cheaper than the sector median, despite them being a market leader in the US, which is probably why the current stock price is also the only one of the three to trade below the average analyst price targets. And there's reason to be optimistic about their future too, coming off this dip here, as the travel economy has almost entirely recovered from the pandemic, with airplane flights already hitting new record highs last year, cruising also hitting new record highs too, and hotels and home sharing have largely recovered as well, and that should continue to see rapid growth in the coming years, which bodes very well for an online travel and booking agency like Expedia. I get that Booking Holdings is larger, and I get that Airbnb is the more disruptive force at the moment. That's where I would say all the risk comes in for Expedia. But my argument is that I would say against Booking, for example, would be the much cheaper valuation, which they also have against Airbnb. Plus, they've also been doing a lot of work integrating new options onto their already very large platforms to offer more Airbnb-like features that is helping them kind of retain market share and fend off Airbnb too. It may not be one of the safest stocks out there, but with the valuation as low as it is and with interest rates dropping too, if we avoid a recession, I could see travel remaining strong and Expedia should outperform in that scenario. Either way though, longer term, I think that it'll be a winner from its current valuation, and it's a decent play on the travel markets overall too. So kind of a good way to diversify into those areas if you don't already have some of that exposure. I don't own the stock yet myself, but I am heavily contemplating picking up some shares very soon. All right. Finally, guys, that's going to leave us now with stock number 3, the highest risk of the bunch. And for this one, I'm actually going to go with perhaps a lesser known name in artificial intelligence, but one that has been beaten down into the ground and is trading at such a cheap valuation that I just think it's being heavily slept on, and I'm picking up shares myself. And that is Super Micro Computer, ticker symbol SMCI. This is a company that basically sells various components for computing servers as well as the actual full-on servers themselves, which is really one of the things that really help them stand apart from the competition, is just how highly customizable their servers are that can be tailored towards really any specific workload of various sizes and types and tasks, including of course artificial intelligence and supercomputing. As a result, Supermicro's platform is often used in combination with NVIDIA GPUs, and they've even partnered together with NVIDIA for NVIDIA's Omniverse as well. Another standout feature is their liquid cool technology alongside other innovations that really help their servers run more efficiently than much of the competition, where they claim to offer the highest compute density. Very important, makes them more powerful while also still being able to reduce heat and electricity, sometimes by anywhere around 40 to even 90% depending on the rig. That's huge, guys. It's a huge proposition for a market that is absolutely on fire, with the number of hyperscale data centers continuously growing by giant amounts every year as the adoption of AI continues to rise. But one of the things that people are always worried about is how much energy that takes up. Well, Supermicro's technologies are a bit better than most. Now, as a result, Supermicro's financials have also been soaring right along with that too, with sales and profits more than doubling in size last year. And yet the stock price actually crashed more recently, mostly due to two primary concerns. Number one is their falling margins that have been steadily dropping over the past year or so. Now, Supermicro claims that this is due to initial costs related to their newest innovations like liquid cooling technologies, which they feel those components will get cheaper for them over time and thus start to help them grow their margins again over the next couple years. So it's a bit of kind of a waiting period for now, but it's one that Wall Street doesn't seem to really want to wait around for, and especially if it might be signaling more kind of pricing competition. That's something that you always worry about when you see weaker margins, pricing competition. If Supermicro can't really compete as strong enough, if they don't have a strong enough moat to fend off the competition, then that is something that can start to eat away at the margins. Now, I personally think that they do have a decent moat because of, again, the much better and more innovative products and technologies that they offer, but it's a concern for investors nonetheless. Another issue, though, that they've run into recently was catching the attention of a major short seller known as Hindenburg Research, which tends to short stocks, then release negative reports on that company to send the stock lower and thus profit from it, which in this case, they claim that Supermicro has committed accounting malpractice. Now, normally I wouldn't pay too much attention into what a short seller is telling me because, of course, they tend to be incredibly biased. However, in this particular case, it is a bit more of a cause for concern, given that the DOJ has just today, at the time of making this video, they're now reportedly looking into the company as well. Now, this is a developing story. It's already caused the stock to sink like 15%. And we don't have much of any details on it so far. So keep in mind that if you're watching this video at a later date, you probably know much more about this developing situation than I do. So I'm working with limited information here. But at the moment, Supermicro has already denied the claims made by the short seller. And in my premature opinion, again, with the limited information that I have, I just think that this is more of a short-term kind of issue that will cause volatility for sure. It's hurting the stock a lot, but ultimately I don't think it'll matter as much in the grand scheme of things because I think Supermicro will remain just such a critical piece to the ongoing build out of AI infrastructure worldwide that it's more just going to be a drag in the short term, whereas longer term the business should still be intact. But that's just my opinion. Either way, though, it's already been enough negative press to crash the stock, sending it down well over 60% from its highs. Again, there's multiple reasons for that, but it's fallen a lot. By the way, there's also going to be, as if there isn't enough crazy things going on, well, there's also going to be a 10-for-1 stock split in just a couple days. So keep in mind that the actual stock price will probably be somewhere in the 30s range once this happens. And just my quick opinion on that too is that while I don't normally care about stock splits because it doesn't change any fundamentals about a stock, well, they do usually outperform the market, historically speaking at least, with more than double the gains than the S&P 500 on average over the following years. So I do think that it's something worth mentioning nonetheless. Now, something that is much more important to me though is just how dirt cheap of a stock this has become now, with a PEG ratio of only less than 0.3. Guys, that is so damn low. In fact, it's over 86% cheaper than the sector. Even if the company is going through some struggles right now, which, by the way, sales are still expected to grow by 88% this year and another 17% next year. It's kind of correct a little, with EPS also soaring by over 50% this year and 30% expected next year. Well, that is a ridiculously low valuation for that kind of performance, in my opinion. Again, obviously things could get worse. I do think it's a higher risk stock than usual because of these various factors, but with the rise of AI, I just think this could be easily, a slept on player in the AI space that is worth picking up. So we actually just added it to the community portfolio, and I am also adding it as of right now to my personal portfolio too. A small speculative amount, but yeah, we'll see how it does there. Anyway, thanks for stopping by, my friends. Thank you for all your support. I hope you enjoyed this month's update. Let me know down below in the comment section how you feel about these stocks, what you're picking up yourselves. I may include them in future videos. And yeah, I'll catch you guys in the next video. All right, take care, my friends. Bye-bye.